So when it comes to setting up a hedge fund, what are the kinds of things that you should be aware of? A lot of people are interested in this right about now because of everything they're reading in the news. So I've made some notes and I want to cover some of these issues with you. First of all, strategy. Probably one of the most popular strategies and easiest and simplest is to go for an equity long short or a foreign exchange long short fund. Unless you've got some specific particular reason why you've got skills to be in another area. You're not going to be HFT most probably, which is high frequency trading. You're probably just going to be going for momentum or trend following. Some of the biggest and most popular funds are in this category: Winton, Aspect, AHL, Brevin Howard. So you're really, to some extent, going to be competing with those. And you might say, well, if I'm competing with those, I don't want to do that. I want to do, say, merger arbitrage. Well, again, don't worry. It's a crowded field there as well. So first and foremost, the strategy you're going to adopt, and that's really going to be down to your skill levels. Now, strategies, quite frankly, are to a penny. Go to Oxford University Maths department, as I always joke, and you'll find a lot of people who'll be able to help you with strategies. Capital raising is really difficult, and we'll come to that in a second. Secondly, your track record. Okay, now, of course, demo accounts are great, but seriously, nobody is going to give you money other than your mum if it's just purely based on a demo account. I'm afraid you're going to need to get capital to develop a track record and at least 12 months of track record as well. And it can't be just one trade in 12 months. I'm afraid there's going to have to be some kind of minimum number which you've been trading over that period to showcase your strategy. And you'll have to explain your strategy in plain English, even if you've got clever algorithms behind it, because your investors will want to understand the basic thesis behind it and why it's so different to what other people are offering. So like I said, when it comes to track record, I'm afraid 12 months is the absolute minimum, and many funds and people won't give you money if it's even 5 years or 10 years. So 1 year is the bare minimum. The other thing to remember is how much capital you're trading with. Most will say, no, when you've got a few million, come back to me, because they know you won't actually get to that point. So that's important. Do it with live cash. Where are you going to get it from? I'm afraid it's going to be friends and family, like any other business. Of course it's going to be friends and family. That's how most people get money. It's always friends and family first. Nobody owes you a living. You're not entitled to get money. So that's the most important thing. And I'll come to performance in a second, because most people think the most important thing with a hedge fund is performance. I'm afraid it's not. You're handling other people's money. It's got to be in a safe infrastructure. So I'll address that in just 1 second. Now, the next thing, domicile. When I set up my first one in 2004, the fund itself was domiciled out of the Cayman Islands, even though our asset management company was British. Okay, and the reason we owned the fund domiciled out of the Caymans is not because we're trying to dodge tax or evade it or anything like that, as the press might wrongly make you believe, or lazy journalists will make you think. The simple reason is we have investors from all around the world from different countries who all have their own specific domestic tax rates. Some of those countries will have double tax treaties with, for instance, if we domiciled out of the UK with the United Kingdom, others might not. So they wanted funds domiciled out of a jurisdiction which itself charges zero tax, so they're only, when they're repatriating their money, paying tax in their home country. Us as what's called a general partner, the actual owner of the fund as well, the asset management company, the AMC, based out of the United Kingdom, it meant we weren't giving tax to any foreign government, certainly not the Cayman Island government. We were repatriating all our profits back to the United Kingdom. And as for profits, it's usually 2 and 20 your fund starts off with. 2% of assets under management, 20% of the profits you generate for the clients. Okay, and as I said, as they get repatriated to the United Kingdom, we paid all our tax in the UK because as well as the company being headquartered here, the asset management company, so was I as the shareholder, the major shareholder. Next step, setup. How are you going to go about it? Well, you're going to have to meet a lot of different people. The lawyers we chose for the UK asset management company happened to be Simmons & Simmons because they were the number one. And this is where it's really important to make sure the professional service providers you use signal that you're a quality outfit. So we went with the number one law firm in the UK for hedge funds, which was Simmons & Simmons. For the Cayman Islands, it was a law firm called Walker's. Why? Well, because they were the number one for Cayman Island hedge fund setups of the nature and type we wanted. Accountants. Now, these are equally important. I'd probably say a little bit less important than the lawyers, and I'll tell you why. Because more important than the accountants is your auditors. Our auditors were PricewaterhouseCoopers. By the way, our regulatory body was the Financial Services Authority out of the United Kingdom, and of course the Cayman Monetary Authority as well. But most important is the Financial Services Authority. Why? Because it's a credible regulator. And the rest of the world wants to see, when you're raising capital, that you've gone with a credible regulator. Okay, custodian and custodian bank and administrator. Now, administrators, incredibly important. Okay, they're the ones who will work out how much returns you're actually making. And you might think, well, why can't I just make that out and tell my investors how much I've made? Nobody trusts you. That's why. You always need an administrator to make sure everything, all the trades are tallied up. So whatever trades you've placed through a prime broker, and we started off in 2004, our prime broker was, wait for it, Bear Stearns. So guess what? 2008 comes, we've got to find a new prime broker. Our assets are all in safe custody with our bankers, so there wasn't an issue there, but the prime broker is used. Think of a prime broker as an institutional quality broker. We would have to have our board meetings offshore because the fund was domiciled offshore. And if we didn't want it domiciled in the UK, I would have to fly to New York to the offices of Bear Stearns to have our board meetings for our Cayman domicile fund. Why not in the Cayman Islands? Well, it killed two birds with one stone to go to New York. There's not much happening in the Cayman Islands other than a nice beach. So I would fly out to New York. Your board of directors on your fund, by the way, will have to be majority offshore for the domicile of the fund to be offshore. And remember, the domicile of the fund is offshore, not just to benefit you, so all the profits are repatriated 100% back to your country where the asset management company is, in my case, the United Kingdom, and 100% tax paid here, but also, as I said, for the benefit of your investors, you want it domiciled offshore, as I said, in this case, in the Cayman Islands. Okay, and my board of directors were also domiciled offshore as well. So we've got administrators, custodians, prime brokers. You're going to have to meet quite a few. Many won't accept you if you've only got relatively little sums of capital under management. Auditors, accountants, lawyers. Now, lawyers and accountants and auditors will happily accept you as long as you can pay their fees. The cost of those fees will be amortized or spread over about 4 years on the performance of the fund. So if the fund, whatever it performs, each month a proportion of that will be spread out in terms of legal fees. The lawyers you'll be paying up front, I'm afraid, but the fees will be spread out for the purpose of the accounts to work out what your performance ratio is. Now, the good news of that is that you're not paying it out of your own pocket. The bad news is that your clients are paying it and it hits their performance. So be warned on that. It can make what otherwise would have been good performance look pretty poor. The alternative around that is you as shareholders pay it and not charge it to the fund. The normal practice is to charge it to the fund. This is also why you need a lot of capital to start off with, so that the costs are a very tiny proportion of your monthly performance and therefore does not damage your performance figures, which will be essential to raise more capital. And when I'm on the subject, we'd have a saying, we would only ever raise on an up month. If we had a down month, we wouldn't go capital raising because it looked bad. And of course you're going to have down months. And you're going to, of course, have up months. Those what you've got to be ready for to go out marketing. Coming to marketing and raising capital. Prime brokers will have a capital raising department. They're not going to help you. You're a startup. Unless you're coming in with about $1 billion, they're not going to help you on capital raising. But what Bear Stearns did for us is give us that entire spreadsheet for capital raising. That included every single global, well, non-US, global non-US high net worth family office sovereign wealth fund, including the name of the individuals we should approach, their email addresses. I've still got that spreadsheet. It's invaluable. Okay, no, I'm not going to share it. That's what really helped us on the capital raising cap intro. Whilst their cap intro department at Bear Stearns wouldn't go out and make the introduction themselves, they're too busy, they're too big for us. At least we got that spreadsheet. And so try and get your hands on that. They'll all promise before you become a client to give you cap intro. They won't do it because you're too small. Okay, and that's critical because guess what? The scarce resource is not winning strategies. The scarce resource is the ability to raise capital. Our secret sauce, Bear Stearns' Cap Intro Excel spreadsheet. And to this day, I've got those connections. It helped us get the meeting with, for instance, Lakshmi Mittal's family office, okay, at his offices in Berkeley Square in London. These things are critical. Family offices of other multi-billionaires. Without that list, we couldn't have done it. Of course, what was critical is some warm introductions and the chance meetings with people that you have. For instance, one of my meetings was I was having dinner. I happened to be a visiting fellow at Corpus Christi College, Oxford. They asked me to host a dinner for a billionaire financier. Guess what? I pitched him over dinner. And he arranged for the head of his family office to come to my offices to look through my fund. That was another critical, important factor, those networks and connections. I wasn't born with a silver spoon in my mouth, so I had to use every single way I could in order to get those access and those funds. So what else? What else is there? Well, what we do for marketing is this. Every weekend, we do what's called an objection clinic, where I would pitch the fund, but we'd write down all the objections the other person might have, such as, why should I give it to you and not Goldman Sachs? You're young, it's a first-time fund, you haven't got a lot of capital under management, your track record's not long enough. Why should I invest in this sector, this segment anyway? What assurances are there you'll perform the year after? All of these objection clinics had to be handled. What's your credentials? Now, again, I'd built up my credentials over a number of years. I'd written 18 books on investing. I'd won competitions on Bloomberg, on Channel 4, and the Financial Times. All of these things are incredibly, incredibly important when you're raising a fund because, again, the issue is, why should I give you my money? Why should I give you my money? Okay, so those people who think, oh, I'll just do a couple of trades and somebody owes me a living, doesn't work like that. Couldn't care less. I get 100 approaches a week probably of people saying, oh, I've generated this and I've generated that. Doesn't matter. And again, I'll come to in performance terms what does matter. Then comes size of fund. The bigger the better, of course. But guess what? You're a startup. You don't have great connections. You won't have a big fund. That's going to be a problem for a lot of investors. They're not allowed to invest in a fund where their investment is more than, say, 5% of the total assets under management. So you got a cap there. It's a chicken and egg. Nobody owes you a living though, I'm afraid. So they can't just give you the capital because you say, hey, look, I'm a really nice bloke, help me get a leg up. It doesn't work like that, I'm afraid. And so networks really do determine your net worth. Networks determine your net worth. You're gonna have to build better networks, really better networks. Okay, how do you do that? You're going to have to get onto boards, you're going to have to volunteer for things, you're going to have to turn up at events, you're going to have to be on a variety of different councils, and in order to get those, you're going to have some natural abilities and skills as well. Not easy, is it? Neither success, otherwise we'd all be billionaires. So that gives you an idea in terms of size, longevity. I've said marketing, capital intro, setup, domicile, track record, strategy. Let me close with this. The most important factors that an investor looks for before they become an LP or limited partner in a hedge fund will be Sortino ratio and alpha. Alpha is the ability to outperform the market. The Sortino ratio is consistency of mean returns. So it's not just the returns you generate, but also how consistent you generate them. The Sortino is not the Sharpe, it's actually better than the Sharpe ratio. The Sortino says upside volatility is good, i.e. if you overachieve your average, it's good, but if you underachieve it, you should be punished for it. And that's what it looks at. And it basically essentially is saying what's the standard deviation around the mean. So Sortino you'll have to work out for your fund. Alpesh, how do I do this? If you need to ask, you're not ready to launch. Okay, if you need to ask, you're not ready to launch. Alpha outperforms the market. The next most important thing is correlation. You see, investors will already have invested in a whole bunch of assets. They want to get into something which isn't highly correlated to what they've already invested in. Okay, so the less correlated you are, for instance, to the S&P, on the number of months the S&P rises, how often do you also rise? Because that would suggest you're correlated. But when it rises, how often do you fall? Well, that's not good. That means you're not even going up when the market goes up. Most important, when the S&P falls, and taking that as an equity long-short benchmark, how often do you rise? That's going to be important. And not just for the S&P, that's oversimplistic, but correlation to other asset classes as well is very important because all your investors will know the more uncorrelated assets in a portfolio, their portfolio, the more likely they are over the long term to get wealthy. Or put another way, they're at the efficient frontier of investment. Don't know what the efficient frontier is? You should not be launching a hedge fund. And the final question when it comes to launching the fund, why should they give their money to you when they could give it to Goldman Sachs? You've got to be able to answer that as well. For us, it was because we had data to show that younger managers tend to outperform in the first couple of years before they become fat and complacent and don't have hunger anymore. And that was important at the time we were capital raising, because some of our big institutional investors said, yes, we want young new managers. Okay, so we got lucky. Yeah, guess what? It's a business. Luck is an important factor in business. It is an important factor in business, being at the right place, the right time. All of these things are important. By the way, would I launch a hedge fund today? Would I do it now? No. I'd probably set up a fintech company in software. I'm not the only one. A chap called Jeff Bezos, who used to work at D.E. Shaw, the hedge fund D.E. Shaw, left it to set up a software company called Amazon. And he's the one who became a trillionaire, not D.E. Shaw. So what would I do today? Financial technology and software. But heck, the hedge fund industry, it's allowed me to get to where I am, and I'm most grateful. Hopefully you found that all helpful. Don't forget to like, subscribe, all those things people do in social media, and I'll give you a heck of a lot more insights as well. Follow me on LinkedIn, ask me any other questions you've got, and we'll go through some of those if you need those pieces of assistance. And no, you can't have the CAP intro Excel spreadsheet. And the reason for that is not because I'm being unhelpful, but because, guess what? I had to do it the hard way. There has got to be a limit to how much help you give people, doesn't there? I didn't grow up with a silver spoon in my mouth, but the CAP intro Excel spreadsheet, that's actually my intellectual property, my proprietary IP I'm going to keep hold of, if you don't mind. Thank you.